So who's got the first question? Just unmute the mic and just ask the question.
Is there a video in the mentorship like specifically about market structure shifts?
So market structure shift, right? It's kind of a thing that gets touched on many times in the weekly commentary. We touch on what a market structure shift is. If you want, we can touch on that quickly now before we go on to the arrays. Let me just share my screen.
Oh no, because if there's like content about market structure shifts, then I'll just watch it in it. You don't have to explain it now.
Yeah, cool. So there is quite a few videos. You see the weekly commentaries, right? And let me just share my thingy. You guys can see my desktop, right?
Yeah.
Yeah, cool. So with the market structure shift, it's touched on in loads of weekly commentaries. Now, if you're not watching the weekly commentaries, watch the weekly commentaries. I'm telling you why, yeah. Every single weekly commentary begins the same way. It begins with me building my bias, and you're going to see the tools that I use, the tools that I fall back on to build a bias. That's the start of, that's in every single weekly commentary. That's how I build my bias. It's shown there. Now, if you watch it, right, every single week you just tune in and you watch it and you rewatch them, it's gonna rub off on you, and you're gonna see that how I do it, use and implement what I'm using yourself, and you're gonna see how I build a bias, right? Now, in the weekly commentaries as well, we go and touch on how price trades within the week that just traded, and we go over things that, you know, if there was a specific model or whatnot. And in the weekly commentaries, I'm sure there's at least 5 weekly commentaries there's been a mention of a market structure shift, especially maybe between like the middle of the mentorship, because that's when we start to talk a lot about intraday stuffs and whatnot. But essentially, with regards to chapter 2, a market structure shift is directly linked to a breaker block. A breaker block is the component that you find in a market structure shift, right? So if you want to look at here, so like a 1 minute DXY, right?
Yeah, nice market structure shift on the Bitcoin just before the move down.
Yeah, even here, this is an example of a market
Can't see
structure shift.
chart.
Can't see the chart as well.
You can't see my chart. All right, give me a second.
It's showing the you know, the picture you had up when he's talking about market making.
Drag it to your other monitor.
Oh, right. What about now?
No,
That's still the same.
You can't see my screen still.
you can just see your home screen.
All right, cool, 1 sec. How do I get like the whole panel of you? Oh, yes, it. What about now?
Still the same, bro.
Okay, now you should, right?
Yeah.
Yeah.
All right,
Yeah.
So let me get this to the side here. So market structure shift, yeah. You see, so let's say we're looking to get short on the dollar, right? Now you're seeing this consolidation, right? So essentially like a power 3 play. So you see there's buy side liquidity that's resting above here, but you're looking to get short on the dollar. You're waiting for a signature to appear to get short on the dollar. Now the market structure shift, and this is what people call the QM model, by the way, the market structure shift with a return back to the breaker. Now you see this piece of price action right here, yeah? You go high, you go make a low. Then you see how you make a higher high, and you see when you trade beneath this low, you go lower low here. That's a market structure shift. Now, how do you get in line with the market structure shift? You see if there's like a fair value gap left here. Like here, right?
Yeah.
There's a fair value gap left here.
Yeah.
There's this breaker block here as well. You see how when you look at to the fair value gap, and I told you, I say this in one of the weekly commentaries as well, whenever you see a fair value gap, cut to the left of it. What does cutting to the left of it mean? Look if there is a block to the left. What's here? This is a breaker block, right? This down close candle prior to the high being run and then the lower low being made, that's a breaker block if you don't have that as your in your notes already. And then you get the trade back into this 50% of this fair value gap, and then there's a sell-off in the DXY. Of course, it's all in the time of the New York open kill zone as well. Algorithmically, the market structure shift from chapter 1, right? If you've done your notes from chapter 1, all that the market structure shift is doing is it's a change in the state of the delivery of price, right? From attacking buy side liquidity to attacking sell side liquidity. Because if you think about it, right, and it's when you start to think of it algorithmically, right? Think of it as what is it delivering, sell side or buy side liquidity. Now there's buy side liquidity above here, right? You see how we trade above it? That's delivering a buy side liquidity, right? You're hitting buy stops, you're triggering buys into the market, right? Now, when you go higher high and then lower low, what's going on there? You attack buy side. Now, if you're attacking buy side liquidity, there's two criteria that I look for. The first one is respecting, right? You see this low to this higher. This should be kept intact. If we're about to go higher, this low shouldn't be attacked because this is the low before breaking this. This is an external low on this 1 minute time frame. Why is it an external low? Because you're breaking this high, you're retracing, and then you're breaking this high. You see when a high is broken, that's breaking external range, right? You see this range? Once you trade above it, this is now the external range from here to here. So when you break the external low, that's going from attacking buy side liquidity to attacking sell side liquidity, right? So then what's likely to happen after the market structure shift? You're going to go and attack more sell side liquidity pools. Of course, in the context of everything, right? Like chapter 3 and chapter 4's context, you can't just find this anywhere. You're looking for this specific signature in specific places. For example, higher time frame price arrays, right? So all of you done chapter 2 or you're doing chapter 2, what do I say every single time? The price arrays on a higher time frame is for what? Any of you?
Bias.
It's for bias, right? That's where you're looking to frame your trade ideas. You don't look to enter on a higher time frame price array unless you're like a position trader, right? But on the lower time frame, you're using it to frame entry, right? So let's say that this run up, right? You see this run up on the 1 minute. Let's say this runs up, and on the left of here is a 4-hour fair value gap. Looking for this market structure shift in that 4-hour price array, that could be, the model that you want to trade within your high time frame price array, right? But has anyone got a question specifically to do with how do you identify a specific array or anything like that? Like, I know a lot of people, they get mitigation blocks confused and breaker blocks confused. Rejection blocks, some people struggle with as well.
Yo,
You could go deeper into receptor and rejection blocks.
If someone wanted to go over rejection blocks.
You can go deeper into it right now if you want to.
So rejection block. Okay, I'm gonna tell you one thing that I'm gonna tell you a common mistake that people do. A very common mistake. When people look for price arrays, especially for rejection block, yeah, you see what they'll do is, because I always ask you guys, make sure you send me examples so that I know you understand the content, right? And what they'll do is they'll find a piece of price action that's consolidated like this. You see consolidations like this, yeah? You're not looking for arrays and consolidations. You're looking for arrays, right? If you've done chapter 2, lesson 7, the final lesson, right? The PDA array matrix, you know that the price arrays are components of a price range from high to low, right? So for example, if we just take this high to low here, yeah? Just this high to low. In this high to low, right, we have a fair value gap in the discount and it extends up into the premium, right? So if let me just change this one to, now, this is how you look for your price arrays. You have to find a high and a low. Don't look for consolidations. Look for a high and a low. And how would you find it? Look here. This is what? This is a mitigation block. You see this candle here? We're looking at from this candle's high to this candle's low, yeah? We're looking at the range here. Now, what do we have? We have a fair value gap. This down close candle before the failure swing high. Does anyone know what that candle is?
Order block.
It's not an order block. The down close candle before the failure swing high and then the move lower.
Mitigation.
It's a mitigation block, right? Now, why is it a mitigation block and not a breaker block?
They didn't break structure.
It's a failed high, innit?
Yes, exactly. The only difference there, and let me, you know, this is time to put this question to bed. I get this question every day. Let me go. A mitigation block, right, would do this. You come down. This is a failure swing. Now, why is it a failure swing? Because if it's not a failure swing, it's going to go and break the previous high. This is the previous high, right? Now, let's say it comes to here and it fails. Here, right, and this should look familiar to you if you've watched the mitigation block video. Here, the lowest down close candle within this low. In this low that's created here, because this low could be a few candles in when it's like a candlestick chart here. The low prior to the failure swing high and the move lower, that's a mitigation block. The only difference between this and a breaker block, I'll keep them side by side, is this. Can you see the only difference? You see this one is a failure swing high and then you move lower. The breaker block, the only difference between the breaker block and the mitigation block is this. The breaker, so they're both bearish examples. The bearish breaker will take the previous high before going lower. It will go low, higher high, lower low. Mitigation block, simply if you lot came from like a retail background, you know, like a break and retest of like a old high or old low, simply that's what a mitigation block is. And that's why you'll see that the break and retest of specific highs and lows works. It's not working because of the idea, oh, it's just a high or low. There's no logic behind that. Why is retesting that high or low working? It's the idea of mitigation. There's that mitigation block that rests inside of that low or high that needs to be mitigated. So price will go trade back there and then move away from it. Does that answer anyone's questions to do a breaker block and mitigation block, or are you still confused?
What is the actual meaning of like mitigation?
Okay, so mitigation, if you just look at a normal example, is to, you know, to mitigate something is to like,
Mitigate
you know,
out of orders.
yeah, mitigate out of orders. Like, you know, you could kind of say like a synonym of it is like kind of like resolve or break even, essentially, right? Mitigate it. Mitigate either means to reduce the loss on it or to break even from it, right? Now, if we go back here, you see this push up. You see this push up here, right? You see the commercials, and the commercials are be like smart money, like smart money. Now, what is smart money? They're the large entity players, right? They have large enough pockets to make this move occur. They can make this move occur and still hold a short position. So they are still short because they don't just short and long at just one specific price. They will hold their positions for very long amounts of times, right? So already here, they opened a long position, but their net position is short. You with me, yeah? Their
So,
net
like,
position,
the
the
reason why it
overall
returns to there to close the buy
long,
isn't it?
yes, exactly, because
okay.
it gives them a chance to mitigate. It gives them a chance to mitigate it,
And
and
like break
anyone,
even, innit?
yeah, and anyone, right, and other smart money traders is a signature for them to get in line with price. If any of them were caught, right, because when this price feed is delivered to them, right, if anyone was caught on the wrong side being long here, and it breaks down, it's a chance to break even on the wrong position and get in line with the actual short that was meant to be. Do you see my point?
Yeah, that makes sense.
Yeah. Anyone else have any questions with an array? So going back to this one, this is why it's a mitigation block here, because you're making a low, failure swing high. You're not taking out the highs from, you're not taking out this high like here, right? And then you're breaking down lower. Then what happens? You see price comes back into them, into here, finds some sort of resistance support, and then it, you know, kind of trades back lower beneath the range before coming back up and going back down.
Wait. That was a failure swing high. Which high did it fail to take out?
This high. You see this candle's high is higher than this candle's high and higher than this candle's high.
Okay, yeah.
Yeah. The how do I identify a high is very, very, very simple, right? And there's a few videos on this as well, but let's just touch on this one. A high is like this. Simple. There's no complication about it. It's a 3-candle formation. The candle in the middle, the high of that candle has to be higher than the high of the previous candle and the one that comes after it. Now a low is just, if I do this, the low is another 3-candle formation, the inverse. The low of the middle candle has to be lower than the candle prior and the candle after it. That's what makes a low. If you use this, you know, this criteria, this is how you should identify your swing points in the market. So like this candle's a high, this candle's a high, this candle's a high, this candle's another high, right? Anyone else have any other questions? Let me just delete this stuff here. Are you lot done with chapter 2 or are you still going through chapter 2?
Done.
You're done. Okay.
Yeah,
What
I've done
about
it.
you're done it? So what was the things that were like, you know, did you struggle with anything or was it making sense, or when you're looking for it in your chart you're struggling in it? Because I remember when I was studying and when I'm looking at it on the video I fully get it, but when I'm by myself looking for it on a chart it's easy to get flustered and lost. So is there like a specific price array which is hard for you guys to identify?
Could you look for rejection blocks?
Rejection block.
Yeah.
Okay, rejection block is like this. You see at your highs and lows, right? You see at the highs and lows. So this is a rejection block. That's a rejection block. You see when you have your high to low, right? The rejection block is the last array before the run on the high or the low. Now the rejection block is essentially, it comes in the form of this wick. Now let's keep this on. The rejection blocks that I like as well is, you see when you run a high, so you see how this leg higher runs out this high here. When this candle has a large wick and then closes, comes back and closes and moves away, this is what you're looking for in a rejection block. Another example is this, right? You see this wick here. This wick here, how many candles highs does it take out? And what does it do? If we go to the left of it, let me get a trend line. It's a complete fill of this imbalance within this candle, right? And what does it do? It takes out this candle's high and it takes out these highs over here. That's how you're trying to look for your rejection blocks. The ones that I like to take personally, right, is the rejection blocks that either react off of an array or clear some liquidity. Now, how do you see it? You're looking for the wick to do it. You see this wick, once you see that happen and you see it, you know, displaces away from it, this is a rejection block in the wick. This is the rejection block. That's what a rejection block is. Now, again, in a consolidation like here, this isn't a rejection block. Why? Because it's not at the end of the ranges. It's not the high or the low. The first thing you do when you're identifying a rejection block is it in the high or is it in the low? If it's not in the high or the low of the range, automatically it's not a rejection block, because the rejection block is in the PDA array matrix from lesson 7. It's at the end of the ranges. is essentially after the order block, right? You see this order block, this is an order block, right? Up candle, down move, right? The array that comes after the order block in the order of the PDA matrix is the rejection block. And then you have the high of the range, which is above this candle's wick, which is above the rejection block. Does that answer your question?
Thanks.
Omar, you see that first example you shown?
Which one? This one.
Like the rejection block up there, yeah. Would the rejection start from, would it just be the wick of the green candle, or would you start it from the top of the wick of the next candle?
Like this one.
Do you get what I'm trying to say? Like if you move the box up a bit to the top of that
Oh,
wick,
you're saying of the down close candle.
yeah.
Start from here. Nah, just take this candle. It's like this. It's like a fair value gap, right? You see your fair value gaps.
Yeah, once it's been tapped in, you still need to leave the rest of it on,
Keep it,
right?
yeah, keep it on there, because you see an array. There's this stigma around, you know, you see smart money concepts on YouTube. You think that you could trade into an order block or fair value gap, and that's it. It's deleted. It can't be traded to again. It's nonsense. These, right? If you came from a retail mindset, substitute your price arrays for your support and resistance. This is institutional smart money support and resistance. I don't know if you've ever seen the saying on ICT saying, right? He says, we're all support and resistance traders. You just decide which support and resistance you're using. Essentially, it's that.
That's sweet, nice one.
Anyone else have any questions? You don't understand the rejection block, because I get loads of examples of guys showing me consolidation. Remember, when you're looking for a price, the first thing to do, you have to identify the current swing point. So let's look at real time. Let's go on a daily. We can all agree this is a swing low, yeah?
Yeah.
Okay, and this potentially, if the next candle doesn't take out this candle side, that's a swing high, yeah?
Yeah.
Cool. Assuming that this next candle trades down lower, you have now a price range, low and a high, right? Now, what do? Now you form and you see the arrays within this price range, and you see how the 50%, this midpoint here, the equilibrium, this is what separates the premium and the discount of the range. Now, you have multiple areas of imbalance. So you have this candle and you have this candle, right? What's this? Is this a liquidity void or is it a fair value gap?
Fair value.
No, it's not. It's a, why is it not a fair value gap?
Nothing else been traded
because
into it.
Exactly.
It doesn't have any wicks.
You see a fair value gap, yeah? A fair value gap is like this. You see here, forget these candles, yeah? Forget this green candle. You see this candle, how you have the wick here, and you have this wick clearly coming in to overlap it. That's a fair value gap, because in this candle, right, you see after you break this low, there's only been selling offered within this price range. Now this candle, the next one, it offers some buying into it as well. But what's left? There's a gap in that candle. That's a fair value gap, right? Now you see these candles, yeah? These candles, it doesn't even offer. Look, the candle, I know there's a tiny wick here, but ignore that. That is not significant. There is no trading back. The next candle, it doesn't come to overlap this one with a wick. So what's happening? From here on, it's only one side offered. After this candle, there wasn't even any price that came back into this candle's range to offer even a little bit of selling. That's a liquidity void. There's an absence of selling here, right? There's only been buying. Look, it's 1, 2, 3 up candles. Essentially, for every up candle, there should be some form of down candle for it. Now, when you get one way is just offered, just buy candle printed off the buy candle, printed off the buy candle, that's a liquidity void. Let me go to the 1 hour. See, like you see here, you see this candle. You see how it has no wick at the bottom, because I saw this happen today as well. You see how it has no wick offered at the bottom here. It's just a void. If you get the actual definition of a void, it means like emptiness, absence, whatever. Like space is a void. There's nothing there. right? It's only one side offered. The opposing side, in this case, is buying. It's completely void. It's not there. So what's the algorithm going to go do? It's going to go and offer the opposing side back so that this range is fairly, it has fair value in that range. Always equally distributed with buying and selling.
That makes sense. Also,
Yeah.
on that chart, yeah.
Yeah.
You see that massive down close candle?
This one, yeah?
Yeah, the one next to it, the open.
This one.
is no, to the right.
Yeah.
Yeah, that one. Look at the open and the close. They're not the same. Is that a volume imbalance or
The open and the close.
no? So the candle you're on now,
Yeah, this one and this one.
yeah, to the left of it. If you look at the close of the massive down close candle and then the open of the one to the right of it.
So the close is 355. Open is 359. I mean, yeah, but it kind of opened higher. But so let's say an example. So this, right? You're saying something like this, isn't it? This will be a better example of the volume balance that you're trying to talk about, right? This right here.
Yeah, no, that's a volume imbalance. I get that. But like
Yeah.
what I just said, yeah. So what is that then? Like, why does
It's
that happen in the market?
So it's still so it's a volume imbalance, but it's not like a visually significant one. But let's use the definition of volume imbalance, is what you said, is when the next candles, so you see the candle that closes, every single candle's open and close should be like, so if this candle closes, the next candle that should be the previous candle's close, the open of that candle, right? So this candle's close, the next candle's open should be this candle's close, right? It should open where this candle left off. Essentially, every candle should do that, isn't it?
Yeah.
Yeah. Now, whenever there's some sort of discrepancy in the open and the close like that, so let's say let's use nice numbers. Let's say this candle closed at 1 and the next candle opened at 105. That's a volume imbalance by 0.5, right? Because the close of that candle needs to be the open of the next candle. That is a volume imbalance, yeah. But I'm saying this one essentially is the easier one to talk about when you're looking for an example, because you see this candle's open, this candle's closed, right? You see this candle's open is way past the candle's closed. That's a volume imbalance. And now in a volume imbalance, let's talk about that. What side of the market is offered in a volume imbalance?
None.
There's nothing offered in it. There's nothing. You see here, there's not buying, there's no selling. So once you sell into it, is that volume imbalance closed?
No,
Once you just sell into it, it needs to buy back into it as well. It needs to buy back into it, because remember, there's nothing offered. Look, when you look at your imbalances, right? Look at them for more than just a candle. There's nothing offered here. Volume imbalance, there's nothing offered in this range because it got skipped, right? Now you trade back down into it. Nothing was offered. Now selling is offered into here. So what's that? That's actually a fair value gap, right? Because now it's only selling offered here. So in that price range from here to here, they're going to offer, you'll see like a wick shoot past it. That's why usually you see like these, I think US 500 has one. Yeah. So like you see like here, right? You see how this candle perfectly comes and trades back into here. Because this candle wick shoots down into it, then this one's closes, right? This is what I touched on in one Snapchat, so it's called redelivered rebalance, right? If this candle overshoots that candle, and then there's a fair value gap created, you're not taking the fair value gap here. It's really from here. And I touched on that. You know that weekly commentary that I touched on with the fair value gaps 2 weeks ago? I think it's weekly commentary 24.
So would you say that's rebalanced then?
That's rebalanced, yeah. I know a lot of people are looking for the full closure here. It's not going to get there. It doesn't need to get there. This is fully closed. You see how this candle comes back all the way into this wick? That's fully rebalanced. Buying and selling has been offered there.
Yeah, that makes sense.
You see my point? Look, selling is offered into this range, yeah, and then nothing's offered there. So they're selling here. Then what happens? Buying back into here, right? That's like that very higher level stuff, by the way. Like when we want ICT's page group, whatever, this is like the stuff that you get like after a whole year. It's kind of long, but yeah. Anyone has any questions? Any price rate? If you struggle with order block, if it's break or block mitigation, this is the time to ask. Not in like, of course, ask me in private as well, but This is like the time we can have like a proper back and forth conversation if you struggle with something.
Do you know on a breaker block, say if a candle makes a high and a low, could you consider like it to be the high and the low, if that makes sense?
So like this candle, how
Yeah,
it makes a high
so-
and a low.
Yeah, so say if it went like high, low, higher, high, lower, low, could you consider that one candle to be the breaker or not?
So for example, let's say this candle, right? Because essentially this is a breaker block, innit? So you're
Yeah.
saying if this candle went lower, low, and higher, high.
Yeah.
No, I'll tell you why. Because the breaker isn't just one candle. You need criteria before looking at a breaker and a mitigation. The criteria being you need lows and highs. One candle doesn't make a low, one candle doesn't make a high. Do you see my point? Remember we spoke about that 3-candle formation of a low and a high? Because a lot of people, right? You see, like, for example, this candle. I think it was Esme that asked me this. I think it was even this exact chart. I'm not too sure. I think it was this exact chart. She asked if it this
Yeah,
if
actually was.
it was this, innit?
Yeah, it was that chart. Yeah, yeah.
Yeah. So she asked, is this a breaker or was this a breaker? And the reply I had to her was, you need to look for the low, right? When you're looking at a breaker block, a mitigation block, the first thing you identify is the low. And then it's the lowest down close candle in that low, right? Now, one candle alone isn't a low, right? But if you take this candle onto a lower time frame, because on the 1 hour, that one candle, let's say on a 15-minute, that's going to be like 4 candles, right? So if we, let me just get the time, it's 16th of August. Right, now you see how this is now a low on a different time frame, right? That's what you need to look for. On the 1 hour, this is the one that's looking like a breaker block. But as when you go to the 15-minute, you can see that this is actually the breaker block. Now, if you go back to the 1 hour, you'll see that both of them get traded to as well. One sec. Yeah. This one gets traded to by this one, and here, I mean, you can get tagged in here, depending where your stop loss is. If it's above the high or not, you could get stopped out. You probably might not. If your stop is up here, you would never get stopped out. And depending where you take profit, maybe aiming for this low, you take profit somewhere like within a few days if you're swing trading on a 1 hour. But that's what you do with a breaker. You're not looking for one candle. You're looking for the low or the high, and then you're looking at the specific candles within the low and the high. That's one mistake I used to use a lot, because you see like SMC YouTube, they teach this one down close candle as just a breaker block. You don't want to do it like that. There's specific criteria for the breaker. Remember, it's the bearish one is low, higher high, lower low. You need those lows and highs first, and then you're looking for the specific candles within the lows and the highs, right? Does that answer your question, bro?
Yeah. Cheers.
Anyone else have any questions?
Hey Omar, go on to the 4 hour that chart
This one.
and outline where would be the reclaimed order blocks for the
Oh yeah,
market
cool.
sell model.
So, all right, cool. Charlie, you asked, right?
Yeah.
All right, cool. So let's do it together. What happens? Yeah, what is the market maker style model? It's essentially when it's the hedging of the chart, right?
Mm-hmm.
So it's going to be some sort of minor displacement when they're selling, right?
Yeah.
Minor displacement here.
Yeah, I've got them marked out. I just want to make sure I've got the right ones.
All right, cool. Let's do it quickly because it's not really a chapter 2 thing, So I just take these two.
Yeah.
Anyone else have any questions about chapter 2? Anything to do with fair value gap, liquidity void, fair value gap with order block, anything like that?
I had a question about the PDA matrix.
Yeah, go for it, bro.
I just want to see how you would use it.
How I'd
for
use it.
trades. Yeah.
Sweet. So the first thing I do, right? The first thing you need to do is identify where you are on, this is how I do it, on a daily, right? you need to find your swing points on the daily, right? Now, if you let's consider this one. And chapter 4 goes deeper with the PDA matrix. The first thing that I mentioned in chapter 4 is this. The PDA matrix is the backbone for your trading. Now, once you have this swing, this, you know, high to low on the daily, you now know what type of trade to take, whether long or short. Now, overall, you're anticipating a retracement to get lower. Where are you anticipating the retracement to? Is your discount. I mean, your premiums, right? When you're looking to short. Now, I don't really outline every single array because once you study enough, you'll be able to just see that this is straight away, this is a fair value gap. This is, you know, a mitigation block and whatever, right? So this fair value gap here, this is the first premium array that comes in of the PDA matrix, right? From this high to this low. So that I'll keep that there. I'll know where I am on the daily all the time. Am I at equilibrium? Am I at the premium or am I at the discount? I'd always do this, right? Now, once I trade into that higher time frame PD array and I'm trading away from it, you see when you get to intraday, right? So let's just line off this chart, midnight. It's not midnight. Right. So now how would I use it? Now, once you have your bias and it's clear and you're trading away from everything, right? So let's use yesterday. So this is Tuesday's midnight. Now going into the market, what are you looking for? You're looking for shorts in Euro USD until that drawn liquidity is hit, right? Now, once the intraday is going towards your direction and it's going towards your bias, right? Or you see the OTE and the PDA. The OTE is a form, it's kind of like a spin of the PDA matrix, because in the OTE, you're gonna have arrays that you can enter off of. Now, for example, right? If you use, so let's say this high and you use this low, right? Let me change this to the OTE. So on this chart, like again, this, yeah, you see when you see this fair value gap is still open, by the way, this one. You see when this candle trades through it, and then this candle continues to trade through it. So when you have the candle before, has a long wick, and then that candle trades through the entire wick again, just act like this wicked candle doesn't exist. This fair value gap is still open, right? When you're intraday, you need a bias, right? This is why a bias is so clear. Because now let's say on intraday, essentially what you're doing is you're waiting for specific swing points to be made. Now the specific swing points that you made is going to be touched on more in chapter 3, but essentially they're the ones that are made in your kill zones. You expect London to make some sort of, you know, swing high, swing low. Now London, the London open session, that is likely to make the opposite end of the range. Now that means on a bearish day, London is likely to make the high of the day, right? So now in your whole bearish context, remember, it's all about context. Your overall bias is bearish. On the daily, you traded into some form of premium and you're moving away from that now, clearly with displacement. Now intraday, all you need to do is find shorts. Fine. If London makes a suspect high, like it's a high and you're not trading, you moved away from it. London made a swing high and you're moving away from it. What you need to do is try and get as close as possible to London's high. Now, when London moves away, it may cause like a fair value gap, for example, with that fast move away from the high in London. Using the PDA matrix in the intraday level is the same how you use it in a daily. Remember, it's fractal. You'll find the high and you'll anchor it to a low. wait for the 50% above it. Anything above that is premium. If there's a fair value gap in there or an order block in there, take it. Once you've identified your premium and the discount, it's about identifying the arrays within it. Do you see my point? Does that answer the question?
Yeah, it does.
Anyone else have any questions?
Okay, I have one.
Yeah, go for
So
it, bro.
you see on the fair value gap, the one you see the wick before the fair value gap on the example that you just used here.
Yeah.
And you still consider a fair value gap. Where would the high be?
It's here. It's here.
Would it be at the on the fair value gap? Would it be on the body of the candle of the wick?
Like that? No. Forget this candle exists. You see the candle before it. Just use that.
Okay.
Like that. Yeah.
Yeah.
What? So that's still an imbalance, even though it's
Yeah. Remember, I made that Snapchat story of
Only
you
selling
delivered-
was offered there, innit?
Yeah, only selling is offered there.
Oh shit! Yeah, of course.
Also,
Also-
you know, for the fib that you put,
Yeah.
where you put that high, there's another high like just to the right of it. Would that be a more suitable high? Or
What, this one?
yeah, that one.
You could use that. You could use this one as well. I used this one because it's the start of it was, basically the start of
That price leg.
that London thingy. The London open kill zone.
Okay.
Yeah. But remember, identify swing points. Now I want to touch on something, yeah, because I want to touch on this in this call that we're having. You need to work, and the biggest skill that you lot need to learn, and make a note of this here if you are still on chapter 2. Chapter 2 is all about training your eye, pattern recognition. Pattern recognition is such a big skill. When I was first learning, I used to struggle a lot identifying fair value gaps. Now, some fair value gaps are easier to see than other ones, right? Because some of them are just so like big and open like this one, but some people may not see this one, right? Some people may not see this small one here, right? Some people may not see this tiny one that's existing between this candle's high and this one. But all things matter like that, right? You need to be able to identify the price arrays. Now, I say all the time, right? When you do chapter 2, find 10 bearish examples and 10 bullish examples of every price array. What this does is, yeah, it just wires your brain automatically. When you open a chart, you're going to see it straight away. Now, everyone talks about back testing, and back testing is a big question. How do I back test? How do I back test? You see, back testing is done wrong across the board. Is done wrong. Everyone, right? Majority of people, what they do is, right? And I learned this from ICT, and when he said it to me, just made sense, right? Back testing is all for you to understand price. It's not about cherry picking a model. It's not about I would have entered and exited here. Whether you like it or not, your back test is done in hindsight, right? And you have to accept that. Yes, you can see where a model forms, but acting and comforting yourself saying that I would have won this trade and whatever, or I would have lost a few here, but majority of the time I won. It's just to boost and comfort your ego. What you need to swap the word back testing for the word practicing. What are you practicing? Are you practicing identifying your arrays? Are you practicing your pattern recognition? Maybe your back testing that day is going to just revolve around, I'm going to find 20 of each price array. Maybe that another back testing session is, I'm going to go and see how the highs and the lows form in the London and the New York kill zone. I'm going to see how many OTEs were offered from London to New York if you've done chapter 4, right? These are the things you need to practice, right? Because it's like any other sport. A footballer, right, doesn't just go in and start practicing in real games. You don't do that. A boxer doesn't just start sparring. No coach, right? Because I know there's a few boxers. There's actually quite a few boxers in the mentorship. It's kind of crazy. If your coach just throws you into sparring, he's a crap coach. You throw him away. You practice things like bag work, pad work, your endurance, your stamina, whatever. These things, right? Your defense. Training is no different. It's about learning skills, sharpening each skill, and then putting it to practice in real time. Pattern recognition is a large one. When you look at a chart, and I'll tell you why, and knowing every single price array is important. Because I know a lot of you, not a lot of you, but there's some of you that before you wanted the easy way out saying, but if I just want to like trade off of an order block or fair value gap, then why do I need to know the other arrays? And I'll tell you the flaw in that. Remember what I said. The high time frame price arrays are used for what? They're used to build your bias. If I trade into a daily order, so let's go back to the daily. Right. If I go here and so if you didn't know what a fair value gap is, right, you would have probably not anticipated the trade back into it, because remember, the higher time frame arrays are for what? Building the bias. Now, if there's a price array that you just shoved to the side and you didn't give too much attention and you don't practice it because you don't like it and it's not comfortable with you, then what about if price trades to that on the high time frame? On the low time frame, by all means, trade off of the ones that you find comfort in. If that's the order block, that's the fair value gap, that's the breaker block. I say personally, if you're gonna trade off an array, I'm telling you from my experience, find a fair value gap and match it with some sort of block. The block being a mitigation block, order block, or a breaker block. So when you see a fair value gap, cut to the left of it. What is to the left of it, right? So see this fair value gap. If you cut to the left, this candle's low, higher high, lower low. That's a breaker block. That's a breaker and a fair value gap. Price trades back into it. That's something that I like to see personally, and that could be yours as well. When you don't know, right? But that's why it's so important to know every single array, because when it comes to knowing every single array, you'll know on the higher time frame if you're trading into this specific array. Okay, cool. I could go find a trade tomorrow. If you find rejection of this, then I want to find the continuation off of that rejection in the other way. But you won't be able to do that if you don't know every single price array. If you only know order block, what about if the higher time frame is pushing into a breaker block or pushing into a mitigation block? You'll never be aware of it. This is why you need to know every single price array. Fine. When it comes to the low time frame entry, pick one or two of your arrays that you like. That's completely fine. But you need to know all of them. That is a big skill. Pattern recognition. If you haven't already, I know some of you here, you show me examples of every single array once you finish the lessons. Don't cheat yourself. You need to actively participate. This is the only way you can learn. You see, in school, people say that they're a visual learner. How many visual learners do you know that done very well? I don't know one visual learner that done very, very well after GCSEs. GCSEs, you can flute them. There's not one visual learner that does well academically past the GCSE level. Unless you guys know any. I personally don't know any. The people that do well are what? They're the ones that study and they repetitively study, the same things. Your trading has to be treated the same every single day, right? Even me, right? When I was studying, I used to just, in my own spare time, I'll find time on my phone, whatever. I'm just on the bus. Everyone has like a smartphone trading view on it. Just go on it and just practice seeing, moves back into fair value gaps. Practice order blocks. Practice identifying rejection blocks or whatever. That's the only way you're going to find comfort in it. That's I just wanted to do that little run, sorry. But you guys understand the importance of it, right?
Yeah, cool.
Yeah, cool, sweet. Because I'm telling you from experience, innit? Because I went through this whole process myself, this learning process, I went through it. And like some stuff, yeah, it's harder. Now, I don't know if there's specific videos where you just like, okay, that's a bit difficult. Let me just, just watch that video and get on with it. You have to hit your demons straight on. Do you see my point? If you're just like running away from the problem is just going to be there. You got to try to solve it. At the start, cool, it might be hard, like this rejection block, I just don't get it. Come back the next day, try it again. If you keep going for like a week hard on it, you will get it. Just so focus on that part, because once you've done it, you've done it. It's probably not going to leave your system, right? It's like when you learn something to do in trading, right, and you study it for some time, it's very hard for you to forget. Like if I, happen to just go on a holiday for like some period, like 2 months, 3 months, I'm sure I can come back and still identify every single price array within this high to low, right? But you need to do that initial work of learning it all first. That's it. Is there any other questions to do with chapter 2? Any questions? None. If it's not, we're gonna end it. So make sure you ask questions. Otherwise, we're gonna end the call.
Yeah.
No questions.
No, you
None,
No,
yeah?
explain everything.
You sure? Yeah.
Nothing to do with
Yes.
the price raise, but do you reckon DXY is placed in the high of the week?
Let's
I
look at
thought
the
it was gonna sweep that
let's look
high,
at let's look at the calendar. Yeah. I don't know why my calendar always does that. It just scrolls all the way to like the. Why is it saying maximum allowed? Wait, I have to refresh this. There's news events, isn't it? Yeah, on Thursday thingy. Why is it when I'm getting to August, it's not gonna let me go past thingy? Did you not have that as well? There's that thingy.
Only allows 90 days.
But why? But we're in like.
Oh wait, I think if you go to the top, there's like a calendar option. It should let you change it back.
But it's
top
not
left.
What here? Nah, but I'm on this bit.
Scroll up.
One sec.
You see the June 26th to 20th, like that bit at the top.
This bit.
Nah, to the right, like up above where it says June 26th. Like
Here.
nah, right, like
Wait,
up
one
there,
sec.
like
I can't see because this.
it's hard to explain because it's on Zoom.
Well, this bit.
Yeah, that bit.
Yeah.
And then
click
on it.
next.
This bit.
Yeah.
Oh, sweet. I didn't have this problem like when I checked it on the weekend though. One sec. I know there's those two things because I saw the news thing. Yeah. This is central banks speaking, and you have GDP as well. You have the man speaking, right? And this is a 2-day thingy, so from Thursday to Friday. I don't think that this is the high, right? I think Wednesday, so tomorrow, is going to be some sort of maybe some accumulation, or we're going to rebalance. But I don't think it's going to be this high. The reason being, right, there's still, you see the Fed, right? The way the Fed is like a committee. Now Powell is the chairman of that committee, right? Now there's other people that work in that committee, and the other people are very, very hawkish on raising the rates. They want a 75, they don't want a 50. Now what's that going to do for the DXY? It's gonna send it, right? Now, of course, there's loads of areas of rebalancing, right? And you see this high, you see the idea of a double top forming more liquidity. It's not because of the idea it's a double top. It's because it's every single high has buy stops placed into it, right? Now, when you have a high and another high next to it, that's just two pools of buy stops next to each other. Do you see my point? And that's essentially what's just happened here. This candle's high and this candle's high, they're relatively equal. If you look at the exact high, 294, 27, you know, it's not much different at all.
Equal.
Yeah, they're very equal. So you can keep it on the thingy, but this high is definitely a target. If it retraces down and rebalances, right? So let's say there's this fair value gap at the thingy, this liquidity void, right? Let's say it comes back to this candle and rebalances here. That's fine. You just got a longer opportunity to be long up until this high is taken.
But you don't reckon it will come down to equilibrium though?
I don't. I personally think it's not going to be. This isn't the high of the thing placed in. Personally, I don't think so.
We'll just have to see, won't we?
Yeah.
Quickly, would you not want to be looking for buys then if it's not at that discount, or it's not like necessarily as strict as that?
This is a good question. This is a good question. I had this conversation with someone before. Okay. So you see every single time, yeah, this happens. Now, you see this move down here. You see this move down here, yeah? What's that? That's a retracement, isn't it? Yeah. If you go on a weekly. It was a retracement of this, innit? You see how we come into the discount and then we shoot off, right? Now, once that retracement's offered, on like now we go to the daily. Once that retracement is offered and prices made another swing point, you're anticipating the run on liquidity after the retracement is finished. Now, when the retracement is finished, you're not expecting a OTE, 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 OTE till the high is made. What's that going to do? It's going to create a trend line liquidity, firstly. Secondly, the market will not move like that. It will retrace. Think of it like this. Get out the fact that it's a daily chart. If this was a 1 minute chart, the 1 minute charts, have you seen when the retracements finish, how those 1 minutes just go print, 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 boom, takes out the high or low? Have you seen it for yourself in a 1 minute?
Yeah.
This brings me back to my Sainsbury's days. It was just 10 hour days.
Amazing correlation.
But you see, like if this was a 1 minute chart and that low's made, right? In a bullish context, that low's made as rebalance the fair value gap, right? This fair value gap here. You see how the 1 minute candles, right? They just go in one way, they'll rebalance a few candles and then they'll move away again. The same thing will happen on a daily. The only difference is the 1 minute takes 1 minute to close and the daily takes 1 minute to close. You see, once you've finished the retracement, once you see this displacement away from it, especially this candle, you see this candle, how it breaks above the high with displacement. Now, if you don't know what displacement is, when you get to chapter 4, you're going to learn displacement in depth. Displacement essentially is, like an aggressive move that leaves fair value gap, right? When this happens, you're anticipating the run on this liquidity. Now, what you do is what I like to do is personally, you see every single fair value gap left, like on a high time frame, like 4 hour, I just outline them and I wait for the rebalance. I don't expect every single retracement to offer OTE. Why? Because the market is going to look to seek liquidity. It's going for that buy side liquidity. It's not going to offer that deep retracement and then go for it again. It's already offered that deep retracement. Do you see my point? Here, from here to here, it's offered that deep retracement. That retracement is the one that sets up the run on the draw on liquidity. So as it's going for it, what I like to do is, you see how these candles, what I love to see here, I love to see this. You see like this candle, it didn't do it here. You see this candle's low, come into this candle the previous day, then move higher. Then this candle comes into that candle's range, moves higher until the range is hit. And that's how you see on like a 5 minute chart as well. Those candles come back into each other, move away higher, come back down into each other, move down higher. I'm sure you guys seen this on a 5 minute chart as well. That's what I love to see. Here, it wasn't really offered, right? You still got a few candles to rebalance. But essentially, after the candles are rebalanced, this candle's higher it can go. Now, even let's say these fair value gaps are held, yeah? When there's a run on this external high, we expect a move back into this range here, especially this fair value gap. After running liquidity, the algorithm will go to do what? Deliver liquidity, rebalance imbalance, and make a run for the high that this makes after breaking this high. See my point?
Yeah, makes sense.
Yeah, sweet. Any more questions?
Yeah, I got a question.
Yeah, go on, bro.
So you see how I didn't take out the high, yeah? But say it did take out the high and then it was a market structure shift, even though it doesn't, our original bias is like bullish,
yeah,
would you still take shorts on the retracement down?
100%. Me personally, on a higher time frame, 100%, because the higher time frame retracement is many opportunities on an intraday 5 and 15 minute chart, bro. But let me tell you something. You see, this is a good question as well, because you need to know when to stop that. So let's say you sweep that high, there's a market structure shift. You'll be bearish, innit?
Yeah.
You need to know, where am I going to be bearish until? This is what people do. And in your biases, you see chapter 1, I gave you that homework. Make a bias every single day. You need to put in your biases, I am bullish until this criteria is met. I am bearish until this criteria is met. Now, if you are framing your bias off of a retracement, you need to frame that bias till when the retracement ends. Logical, right? So for example, this is like an area where you can expect the retracement to enter fair value gap, and it's like 50% of the range ish, right? That's a perfect area for the retracement to end and the run again higher. So you could be short until you find resistance in your price arrays. Now, what do we say in chapter 2, lesson 7? What do we say? We use what to take profit?
Opposing a price arrays.
Opposing price arrays, exactly. So if you got, you took a trade in some sort of premium, in a premium array, you are trading until the first discount array or even the array at the 50% is met. So now on a higher time frame basis, that's not entry, that's a bias. So let's say we were tracing down, right? Because the retracing down here, you were bearish, you're looking for shorts on dollar until you find support at some sort of resistance, at some sort of array. The same could be for here, right? Instead of taking profit at the next opposing array, is you are bearish until the next opposing array, and then you're looking to be bullish again. Do you see my point?
Yeah.
Yeah, cool.
Wait, one more thing, yeah.
Yeah, go on, bro.
You see how the daily was swept. On what time frame would the market structure shift be valid? Cause if it was like 15 minutes, then obviously it's not valid. You get what I'm saying?
Okay, so if let's say there's a sweep of a previous day high, right? If it's a previous day high, use like an intraday 5-minute chart. And you're targeting the previous day's low. Now that's in a bearish context, right? So like you see here, you see like you see here, yeah. Swept the previous day's high. Now, let's say a market structure shift occurred in the high of here. You're at least targeting, right? Intraday, the next day, you'll look to, when that market structure shift happens, where you looking to take profit or where you looking to trade until at least the low of that candle. Do you see my point? It's like this, yeah. Previous week high, I like to, because the week and the daily, it has so much time difference in it. Because there's 5 daily candles that builds up a weekly candle, right? If it's a previous week's high sweep, I need to see some sort of 15-minute market structure shift of displacement. If it's a previous day high, because it's intraday, there's not much time to work with intraday. You agree, innit? There's only like 2 sessions to work with intraday, innit?
Yeah.
So you're hunting that, right? You have that marked out, and then if it's all, you need the context of it as well. Obviously, if you're looking for that previous day high sweep, it needs to be in a bearish context originally, right? Then you can use a 5-minute time frame, right? And then look for that market structure shift, right? That breaker, that high, low, high, high, lower, low, and then frame your trades off of it.
Okay.
Yeah.
Yeah.
Anyone else got any questions?
Yeah, Omar, just touching upon what you said. Why not wait on an hourly chart instead of a 5-minute chart?
For a previous day high sweep.
Yeah.
Because let's put it like this, bro. 1 hour is a third of a session.
Okay.
You see my point? You're not left with that much time. You see my point?
Yeah, I see.
On the 5-minute with that previous day high sweep, on the 5-minute, you can frame it. You'll see like traders, they say like sign like this, like previous day high, 5-minute, 5-minute time frame, 4-hour sweep of a high, 3-minute time frame, weekly sweep of a high, 15-minute time frame. It's essentially something like that. It's because like if you're waiting for a previous day sweep, yeah. Now, of course, you see when you sweep a previous day's high, it could offset a few days of selling, like here, right? But you see, for the next day to get the opportunity, you can use a 5, or if you're not cool with a 5, bro, use a 15-minute. That's completely fine. That's completely fine. The main thing is you're waiting for the market structure shift though with displacement.
Okay. Yeah, I understand now. Got you. Cheers.
Yeah. Anytime, bro. Anyone else got any more questions?
Omar, you were saying something about the premium, the bodies in the premium before I joined. Could you repeat that?
The boys in the premium before?
The buys in the premium.
Oh, what I said at the start of the recording.
No, just like 2 subjects before this.
About long in above equilibrium.
Yeah.
He said
Oh,
buy
that.
instead of buy.
Oh, that. Okay, so look what I'm saying here, yeah?
Yeah.
You see, let's use a replay. just cut this here. Now, hindsight, we know what happened after these candles, right? We know what happened. But what were we anticipating on the weekly commentaries? We're just anticipating some sort of retracement to go higher. Now, you know, before here, yeah, what's the buy side liquidity target that we're going to look to attack? It's this high, isn't it? This high here, 109.3. Yeah. But what are we waiting for to attack? To frame the attack on that drawn liquidity, what do we need to finish first?
Sell side.
We need to finish, the retracement down lower, right? Into delivering into a discount, right? So that smart money can accumulate longs and then the move higher, right?
Yeah.
Now, all right, cool, perfect. Once this swing low is made, you see the swing low is made, yeah? So the retracements, essentially, we can assume here the retracement's finished. In a bullish context, that swing low is made, it delivered into a discount. What is the drawn liquidity now? What do you think is going to happen after this retracement? The candles are going to reach for what? Forget the time frame. Forget the time. It could be a 1 minute. It could be, let's say, it could be even like a 7-second chart. Yeah. Once this happens, all in a bullish narrative. All this in a bullish narrative. Yeah. The lows made, the retracements
Higher
finished.
prices.
You're looking for higher prices. You're looking for the attack on this drawn liquidity, innit?
Yeah.
Yeah. So now when that happens, right, you see when you're looking for price to trade back into a discount on the higher time frame for you to get long again. You see that what I just said there? That's when the retracement is happening. When the retracement is finished. Yeah.
Yeah.
So the retracement's finished here. You see this candle now. Yeah. That candle, if you go to the daily. Now you see these fair value gaps. Yeah, they're not in the discount of the range. I fully understand that, but we've already delivered into the discount of the range, and now we're attacking buy side liquidity. You're not going to keep going OTE to OTE to OTE to get higher. It's not going to happen like that. Once you've already retraced and you've offered that discount initially, and now the draw on liquidity is imminent, it's happening, right? You can look for retracements into, like, you see how these candles are leaving fair value gap. You can wait for, right, the next daily candle to open, see it trade down into this candle. Now, as it's trading down into this candle, if you start to see the daily candle wick, and this is something I do personally as well, by the way, I look at the 4 hour and the daily candles, and I look at them trading into specific areas. Now, when I see it starting to wick away on the daily and the 4 hour time frame, then I'll go to like a 5 minute and see that wick, that creation of the wick I'm seeing on the higher time frame, is that in the form of a market structure shift on a low time frame.
I see. Makes sense.
You see what I'm saying?
Yeah. Makes sense.
Sorry if I haven't shared with the initial guys. That's something I do every day, by the way. If you want me to repeat it, I'll repeat it.
Yeah, say that one more time.
All right, cool. It's recorded as well. So me, when I trade, yeah, I'll have my kill zones lined out, whatever, and then I'll do this. I'll press this button. This button removes all the drawings, right? And when you click it again, it will put them all back on. I'll watch the daily candles. So the next daily candle, the DXY, I'll watch it. And let's say it trades down into this candle, right? And it starts to wick away. I'm watching the daily and the 4 hour, right? If this was a 4 hour fair value gap, I'll be watching the 4 hour fair value gap. Let's say it's the daily. I'll be watching the daily chart. And you see when it's starting to wick away, I'll look for, is that a 5 minute market structure shift in line with my bias?
Yeah, that makes sense.
Yeah. See my point? Wait, can you guys hear me?
Yeah.
Cool. I thought I
Makes
just cut
sense,
out.
bro.
Yeah, cool. All right. Any more questions? None?
Yeah, no, I got a quick question for you, Omar.
Yeah, go for it, bro.
So you see, can you go on a weekly?
Yeah, sure. The DXY, yeah?
Yeah, DXY.
Yeah.
So not the most recent swing low, the one before that, 27th of June.
Yeah.
Yeah, that one. So you see how you said, like, when we're looking to place our fib, and the ranges that we're using, it's the most recent ranges, yeah?
Yeah.
So when you're showing us earlier, you used the swing low before that
From here.
as your thing. Yeah. How come you didn't use the one above it on the 27th of June? Do you get what I'm saying?
Oh, you could use. You see, when it comes to this range, these ranges, yeah, you could use this one. But do you know which one I'd like to use? Now I know what I said is that kind of formation. This fits the criteria, innit? But out of these two, yeah, which one is the most obvious one?
The
The one
bottom
that
one.
you used.
The one that me personally, I think it's the one that I used, innit? Like this is like a clear. It's like a V. Do you see my point? Like when I see like a nice V, to me that's like a swing point. I will anchor my fib from there. Do you see my point? You see this one? You're right. Definition, it is a swing low, but I just like to take the most obvious ones, innit?
Right. That makes more sense.
Yeah.
Thank you.
Nah, cool, sweet. Anyone else have any more questions?
I think that's it, bro.
Yeah, that's it. All right, cool. Tomorrow, yeah, we're gonna do what's tomorrow's chapter 3? Same time, yeah.
Yeah.
Yeah, cool. Chapter 1 is gonna start from next week's Monday. Like next week's Monday, that's when we're gonna go proper. Like every single chapter will be hit weekly basis.
But you're doing this every week, yeah.
I think there will come to a point where every question is going to be answered in the Zoom, and I can just give reference to watch the Zoom or whatever. But I mean, as long as if you guys want it, and I'm not doing nothing, then yeah, by all means, I have no problem doing it. Unless you guys don't want it.
We do still.
Could you play that Wake Up to Reality?
What, this one? All right, cool. Let's end it there, because the guys, they're gonna be watching this back in the pre-recording, yeah.
Yeah.
All right, cool. How do I end the thingy? Is it just when I stop share, it's gonna stop the recording as well?
Yeah, just
You
end
need
the
to press
call.
the button, like
Which-
the record button.
Where's
the
the
bottom? Next to share screen.
next to share screen?
I think
At the
anyway.
bottom in the middle.
What, pause and share?
I don't know actually. It just says
It should
there's
just
a
be when you end the call, I think.
Yeah, I think when it ends the call, it should be fine because it's still, yeah, it says I'm just recording. All right, cool. Let's end it there, yeah? Cool.
Nice
Take care
one
of
for that,
yourself.
Omar. Stay
No,
safe.
no, no.
Cheers.
Cool.
That's one,
Thank
man.
you.
Take care.
Thank
Yeah,
you.
take care of yourself.
Love, bro.
Thank
Is that it?
you. Bye.
That's right. See you later.
Safe, yo.
Safe one.
Cheers, man.